Hello, everyone, and welcome to the fourth quarter quarterly market perspectives with Covenant Wealth Advisors. My name is Broderick Mullins, and I am the portfolio manager at Covenant Wealth Advisors. I'll be your host for this presentation. As you know, 2021 proved to be another year with robust returns for stock markets in the U.S. and internationally. However, we hit some headwinds with the fixed income portion of the market with negative returns for bonds. Let's dive in and look at the numbers a bit more closely. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, both U.S. and developed international markets were up during the fourth quarter, while emerging markets experienced a loss of 1%. Quarterly returns for U.S. and global bonds were flat to slightly positive. For the entire year, U.S. stocks were up 25.7%, and international stocks did great for the 12-month period as they were up over 12% for the year. The biggest hit to portfolios in 2021 was in fixed income, where U.S. bonds lost 1.5% and global bonds declined approximately 1.4%. This decline in fixed income for the year was due to an increase in interest rates, which we have been anticipating for quite some time. The good news is that as interest rates rise, this provides an opportunity for bond fund managers to reinvest in higher yielding bonds, which we have all missed for many years. Next, I'll draw your attention to the upper right-hand portion of the graphic. The U.S. dollar was up 1.8% for the quarter and up 6.7% over the last 12 months. A lot of people do not pay attention to the movement of the U.S. dollar, but they should. The reason is that a strengthening dollar reduces the value of your international investments, and a falling dollar increases the value of your international investments. Thus, another reason to diversify both here in the U.S. and abroad. Now let's look a little deeper at what was driving the returns of stocks and bonds. We'll start by taking a look at how global markets performed for the quarter, and we'll isolate the performance between U.S. stocks and developed international stocks. The two charts show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell indexes, and international market returns are measured with the MSCI World ex-US Index Series, which represents global developed market performance, excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market was up 9.3% in the fourth quarter, compared to up 2.7% for developed international markets in the chart on the right. Continuing the trend from the third quarter in the U.S., large growth was the dominant style. And unlike the third quarter, we now see large growth stocks lead the way internationally. It's important to remember that the performance of any one quarter is filled with statistical noise that is difficult to make sense of in such a short time frame. Now we take a longer view to see how different investment styles have performed for standard periods ending December 31st, 2021. Looking at annualized returns in the U.S., we can see very strong returns for the 1 year, as the recent performance has been significantly influenced by factors such as the continued efforts to recover the initial COVID market downturn, increased investor confidence in a return to normal, and a strong corporate earnings season. Small value stocks had the best performance of the year, returning more than 28% and beating the U.S. market by 2.6%. However, we see that small value has underperformed most other styles at the 3, 5, and 10-year investment horizons. Consequently, we expect that portfolios that have a small value tilt, such as those we typically design for clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. It is important to recognize, however, that despite the relative underperformance, small value has still returned a formidable 12% per year in the US for the last 10 years. Turning to international markets, we see that value stocks in both large and small companies have led the pack over the 1 year period, albeit at a lower total return compared to the US. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the 10-year period at 10% and 11%, respectively. Relating the prior slides, we see that international markets have underperformed the US market at every horizon, with the 3-year performance trailing by 11.4% per year and the 5 and 10-year performance trailing by 8.1 and 8.2% per year, respectively. Given the higher US return, we expect portfolios concentrated in US stocks to have outperformed a globally diversified portfolio. However, as we'll see in the next slide, these relative performance numbers are not reason enough to abandon international stocks. Thus far, we've discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measure of the price to earnings ratio, a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is overall. Thought of another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total US stock market costs roughly $24. Internationally, as we can see in the chart on the top right, earnings are a bit cheaper at roughly $16 per dollar of earnings on average. The values represented here use historical fund and ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for US measures and in the fourth quarter of 2006 for international stocks. So the average is roughly 18 years in the US and 15 years internationally. In addition to identifying relatively cheap segments of equity markets, these ratios also help set the table of forming expectations about the future. Although we like to say that our crystal ball is always cloudy, there tends to be an inverse relationship between current equity valuations and future performance. Generally, investors will bid up the price of certain stocks in expectation of higher future earnings. Therefore, as a particular group of stocks becomes more expensive, their expectations for future earnings growth are lessened because investors are less willing to pay an ever-growing premium for those expected earnings, especially when earnings can be bought elsewhere for less. Put more plainly, the more expensive stocks become in relation to their earnings, the lower their future performance expectations become. I'll emphasize that this is a long-term relationship, and as we've already seen on previous slides, there's a wide range of possible short-term outcomes. Here we have the same analysis, but isolating US equities, so we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings, as the PE ratio has climbed to 34.6 to close the quarter. Small value, on the other hand, even with the rebound in the year, still has a PE ratio under 14 and under the average of the last 18 years. Although many may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing inflation. The charts on the screen show the average performance of different bond maturities and the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see short to intermediate term bonds posted negative performance, with the 3 to 7 year maturities losing 0.8% for the quarter, but were outperformed by longer dated bonds as the longer end of the yield curve fell. It's worth noting that the extreme price fluctuations that we tend to see in the 10 to 20 year bonds are why we like to keep maturities short to intermediate. Although it was a tailwind this quarter, we've seen plenty of quarters historically where the yield curve has moved against us. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see that inflation-protected bonds have continued to be bid up as more investors seek to hedge their exposure to inflation. Treasury and corporate bonds were down slightly for the quarter, while municipal bonds were up 0.5%, indicating a slight investor preference for municipal debt during the fourth quarter. Now we'll look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show us the current yields for Treasury bond investments at different maturities. The bright blue line represents current rates, and the dark blue line represents rates at the end of 2020. In short, the early part of the curve is steeper and is elevated overall compared to 1 year ago. Practically, this means that expected returns on fixed income are higher, but the Treasury returns would have been negative for the quarter and over the 1 year period. It's worth noting that most of the yield curve changes year to date happened in the first half of the year, and that the short to intermediate side of the yield curve steepened significantly, while the long-term portion of the yield curve flattened and even slightly inverted during the second half of the year and the fourth quarter. This is why we saw flat to slightly negative performance in short to intermediate treasuries and positive performance for longer dated treasuries this quarter, despite higher yields relative to last year. Finally, we'll plot the market's forecast of inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations, and the dark blue line represents inflation expectations at the end of last year. Consistent with what many are expecting and what we're hearing in the media, inflation expectations are higher compared to this time last year. It is important to remember that these levels of inflation are baked into the prices today. The markets are pricing an average inflation rate of approximately 2.9% per year for the next 5 years, and the market collectively expects inflation to exceed the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they are also baked into equity prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. The market already expects inflation to be higher than what was previously expected over the last year. And with that, we've reached the conclusion of the presentation. As always, I hope you learned something new. And if you are an existing client, thanks for your trust.